Alright guys, what's going on? My name is Hayden. I'm going to be teaching you guys what I know about options today. I don't know that much about options. I do consider myself fairly proficient, more than the average person. That does not mean I'm an expert. I'm not a financial advisor. I have no degree in this shit or anything like that. So definitely do your own research, guys. Do more of your own research before you jump into options. Definitely don't just watch this crappy little video I'm filming right now and go lose thousands of dollars. So, getting into this, what are options? Options are a contract in which two people agree to trade shares. This amount is usually 100 shares if the stock price matches the criteria on a certain date. There are call options and there are put options, and these are opposites from each other. So basically, what's happening with a call and what's happening with a put are completely inverse. And in every contract, there's a buyer and there's a seller. So the buyer of a call option has the exact opposite view of the buyer of a put option, and at the same time, the buyer of a call option has the exact opposite view as the seller of a call option, and so on. Talking about call options specifically, the buyer of a call option is agreeing to buy 100 shares of the stock at the strike price on expiration if the price of the stock is above the strike price. This means buyers of a call are bullish. And the seller of a call is agreeing to sell 100 shares of the stock at the strike price if the price of the stock is above the strike on expiration. So, when you buy a call, so let's buy this call really fast. We're not actually going to, but if we were to buy this $29 strike on RKT, if the price of the stock were to finish above $29 on March 5th, so in 2 days, if in 2 days the price is above $29, then we would only have to pay $29 per share, even though the price is higher. Now obviously we paid this amount right here. This is called the premium. So this affects how much money we actually make, and this causes our break even to actually be $30.70. So the price, in order for us to actually profit on exercising this option at expiry, we would need it to go up to $30.70. Now, the other thing to remember is that you do not have to hold, when you buy an option, you do not have to hold until the expiration date. When you buy a call, or if you buy a put, you can sell this at any point for any reason. Whether it goes up or down, you can exit out of the trade at any reason. If you decide to hold until close, or until expiration, and it is below $29 still, then you lose your entire premium. So you would lose all $170 of this if you held until expiration and the price ended at $29.00 or below. Talking about selling specifically, selling is a little bit different. If you're selling, you're not actually paying money, you're actually receiving money. And what you're saying is that like I said, you're saying that you will sell if the price is above the strike. So this is risky to do if you already don't own 100 shares, because if you sell this $29 strike right here, you would get $165, which sounds great. But if this were to jump up all the way to $30, you would have to buy 100 shares at $30 and then sell them for $29. You would still actually profit because you earned $165 in premium, which is why IV helps premiums, or helps sellers a lot. We'll talk about IV later on. But as you can see, the break even is $30.65. So if it were to go above this $30.65, that's when we would begin to lose money, if we didn't already own 100 shares and we had to buy them after expiration. Going on to puts, the buyer of a put is agreeing to sell 100 shares of the stock at the strike price if the price of the stock is below the strike. And conversely, the seller of a put is agreeing to buy 100 shares of the stock if the price of the stock is below the strike. So, this is completely opposite of the calls, because buyers of a put are agreeing to sell and buyers of a call are agreeing to buy. So, going into here, if we were to buy this $28 put, we would buy it for $203, because like I said, you need to multiply everything by 100 because of how the contracts work. So you would pay $203, and if this were to go down, your contract would be worth more. However, if you were to hold till expiry, you would need it to go down to at least $25.97 in order to actually break even if you were to buy this right now and hold through the expiration date. Conversely, if you were to sell this, you would receive $186 in credit, and what you're hoping for when you're selling the put is you're hoping that the price actually stays above this $28 strike. So this is actually a really good time if you think that RKT is going to go up to sell this $28 put. If you think that RKT is going to go up in the next 2 days, because you would receive $186, and if it were to go up like you think it will, then you would actually be able to keep all of this because you wouldn't have to give them any shares as long as it is 2801 or higher. Moving on to should I buy or sell? I personally recommend, in most cases, you should only be buying. This is because buying option gives you the freedom to exit the position for any reason, because you can sell your side of the contract to somebody else, either for a loss, profit, sideways, doesn't matter. You can exit the trade at any time and you are not locked into the option. Option sellers, however, cannot trade their contract, as they received a premium, therefore their end of the contract cannot be traded. So they received money, they did not pay money. So since they received money, they cannot give their end of the contract to somebody else. They are stuck in this contract. The only way to get out of a contract, a put or a call contract that you sold would be called buying to close, which I don't know exactly how that works, so I won't exactly get into too much of that. I don't expect any of us to actually be in a position where we need to buy to close, because a lot of us probably aren't going to be selling that many options just because of how selling works. But the other thing is that buying to close can also get very expensive just because of how large losses can happen, especially when you're buying these, or when you're selling these calls. Huge losses can happen if the price goes against you. So moving on, just gonna recap really fast just so you guys have like a quick idea. If you buy a call, you're bullish, contract gains money as the stock price goes up. You pay to enter the position, and you can trade your position at any point for any reason. If you sell a call, you are bearish on the position, or at the very least you think that the price will remain below the strike. It could go up if it wants, as long as you bought. So let's go into here and explain this. So if you were to sell this $31 strike, you would receive $133. You don't need the price to go down from here. The price can actually go up all the way to $31 even. As long as it's not $31.01 or higher, you will keep this entire $133 of premium that you received, and you won't have to pay any shares. However, the second that this goes into $31.01, you are extremely likely to be exercised, and they will start to eat away at your credit. Even though they actually lost money, because it didn't go all the way up to this $32.39 like they wanted it to, it's only at $31.01. They still would want to exercise because they're not losing their entire deposit, only a part of it. This is the mindset of most traders, and you guys need to be ready for that if you are to be exercised for any reason. Moving on, if you buy a put, you're bearish. Contract gains value as the stock price goes down. You pay to enter the position, and it can be traded. If you sell a put, you're bullish on the position. not necessarily bullish. It's similar to the call where it can go down as long as it doesn't break the strike price. You receive a premium, and just like a call, very similar to selling a call, just opposite. Moving on. How is your option priced? So, the price of the option is called its premium, and the premium of a certain option changes as time goes on. The price changes and IV changes. You can figure out how the price of your option will change with the price of the stock and time using the Greeks. So, let's touch on implied volatility really fast. Implied volatility, or IV for short, is how much in either direction the price is expected to move. IV tends to decrease as markets go up and increase as markets go down. IV also increases around corporate news such as earnings, but does not increase with regular news. So anything you guys see on NBC, CNN, that about a company that isn't about its corporate sector or anything corporate related, as long as it's news that will bump the stock price up, this will not affect, or that as long as it's news that will affect the stock price, it will not affect IV. The only thing that will affect IV in this situation with the news is the direction of the market. As IV goes up, it adds value to both calls and puts. So this is important to think about for a second, because if IV increases as markets go down, but IV also adds value to your calls, so if you're buying a call, you want the price to go up. But if the market's going down and IV's going up, yeah, it's kind of mitigating your losses a little bit, but you're still losing money. And we'll talk about why that is in a little bit. That's a whole lot of Greeks. It kind of gets complicated, but we're gonna work on that. So, and finally, IV is the only thing besides time and price movement that can change the value of your option. We'll talk about rho, which is another Greek. Rho is your, we'll talk about it in a little bit. It really doesn't matter that much. There is one more thing that can affect the value of your option, but it doesn't affect it that much. So the main three are IV, time, and price movement. So Vega is your volatility Greek. V for Vega, V for volatility. And it tells you how much your price increases or decreases as volatility increases or decreases. So if we jump into our option chain right here on RKT, we scroll over to our Vega, you see that our Vega is 0.001. We have to multiply that by 100 because this is per share, and we have 100 shares in our option. So for every percent that implied volatility goes up, then our option will also gain $1. Something to think about with implied volatility is that so IV increases around corporate news. So this isn't, earnings report. This is like earnings announcement from my understanding. Definitely look that up. I don't really know when the IV gets raised with these earnings and things like that. And I also don't know everything that affects IV besides earnings. All the corporate stuff that affects IV, definitely something else you guys should be looking into. But one thing I want to teach you guys about before we move on is something called IV Crush. So when you have these corporate news comes out, you're going to see a big increase in volatility. So you're going to see this jump way up from where it was. This means that your premiums, so the price of the options, is suddenly, without really any market movement, just going to explode. It's going to be huge. This is good if you already hold the option because you're gaining value on your option without price movement. And this is because implied volatility is basically pricing in to the premium how much the market is expected to move. So basically it's saying that it's any implied volatility over 100% is considered a high IV. So, which makes sense because you need to go almost a whole $1.50 over this $31 strike in order to be profitable, which is why these option premiums are so high. If we were to jump into the SPY, that's why these option premiums are so low, is because the implied volatility is also very low. Because SPY is a very stable stock. It's a very, not a lot of big movements, not a lot of big down 10% days, up 30% days, things like that. Those things just don't happen with SPY, which is why the volatility is really low. And the reason you're seeing these very high IV on the RKT chain is because we recently had this big run up from $18 all the way up to $48. Something I wanted to show you guys also is these absolutely massive numbers on SNDL. We've obviously seen, a lot of things happen with SNDL over the last couple weeks. My assumption on why the IV is so high is because they've been diluting a shit ton of shares and the price is still held pretty steady. So, I expect as the shares become less and less diluted, whether they do a reverse stock split or as just more buyers buy in, this is going to start ticking up year over year. That's just my opinion. I know a lot of you guys are bullish on SNDL as well. But going on to the other Greeks, we have Delta right here. So Delta is probably one of your most important Greeks that you guys should be looking at. Delta tells you how much the price of your option will go up or down with every $1 of price movement. So, if we buy this call right here on the RKT chain, if we bought this call right now and it were to go up from 28.01 to 29.01, we would gain $46 on our option. So our option would go from 190 all the way up to 230. That's a pretty good gain. So, which is, you guys kind of got to think about that for a second. We're paying under $200, and in just $1 of movement, we're gaining 25% almost on our option. That's why that's where these options, really get their value, is as they move in your direction. But if they move against you, you're going to lose this money very, very fast. So you kind of got to think of it that way. Moving on to Gamma. Gamma tells you how much your delta will increase or decrease with $1 of price movement. So Gamma is what makes your options grow exponentially, which is why you see people who do things where they do things like buy these really far out of the money SNDL calls for way out. So let's look at this. So if we were to buy this $3.50, if we were to buy this $3.50 SNDL call for 135 days away, we would pay $35, or we would pay $30, and the break even would be $3.80. But the problem is that if this were to go all the way in the money tomorrow, well, it doesn't really tell me, but let's do this one. So we buy this $3 for $35. If it just moves $1, we gain $75. So we would almost triple our investment if this were to go up to $2.30. That's crazy. And as you guys can see, as it gets closer and closer to in the money, and as it gets in the money, it gets closer and closer to $1. $1 is the highest you will ever see for Delta. You won't ever see above $1. It's very rare to see $1. I've actually never seen $1. This is because you're buying 100 shares. Your option is for 100 shares. So if it were to go up $1, the most you could get was $1 or $100. So you won't ever see a delta above 100. Talking about Gamma though, as you guys can see, this is the Gamma right here. So if this were to go up $1, we would gain $75. We already talked about that. But if it were to go up a second dollar, we would gain $87 instead of just $75. So that's where it starts to ramp up. You get more and more delta, and you get more and more money as it goes deeper and deeper, or closer and closer to in the money. Talking about theta, theta is another very important Greek that you need to understand, and theta is your time decay. So it tells you how much your option will decrease in value in the next 24 hours. Theta is usually low for options over a month out, but begins to increase faster and faster in the last 4 weeks. And obviously theta will never be positive. You'll never be paid for holding onto an option for a day. You would need price movement in your favor for that to happen. So looking at these SNDL, what the hell, weird, but going to RKT, RKT is probably going to have theta decay. So theta decay on these is about $27 a day. Keep in mind this is only 2 days away, so you're losing like 1/8 or less of your option price over the next 2 days, or really about a quarter. Just about a quarter of the price the next 2 days, so you would need movement in your favor in order to either sell this for a profit or to be profitable by the time expiring. Which, I mean, if we look at the break even for this, it's really almost $2 full above the strike price in order to break even, which is kind of crazy, which is why it's important to pay attention to this IV. Low IV is good for sellers, or low IV is good for buyers, high IV is good for sellers, whether you're selling the contract you bought or if you're just selling in general, if you just want to sell this call right now. Moving on to our last Greek is rho. Rho is your interest rate Greek, and it fluctuates with every 1% of change, and it works off the U.S. Treasury interest rate. It is ignored by most options traders as it has a very minimal effect on the option pricing, if at all. From what I understand, this almost never actually affects your price. I'm pretty sure from my understanding that the U.S. Treasury interest rate has remained largely unchanged, and when we go into our option chain, we see that rho is actually, for a lot of these stocks, or for a lot of these options, 0. If you go into SPY, for the out-of-the-money ones, or for the out-of-the-money calls and the out-of-the-money puts, they're mostly 0. And for the in-the-money calls and the in-the-money puts, they're either negative 0.01 or positive 0.01, which means that every 1% change in interest rate, which, if you think about it, interest rate probably won't change that much, you gain or lose $1 depending. So very minimal. It's very unlikely that it's ever going to, either make you profitable or make you unprofitable because of a U.S. Treasury interest rate change. So for the most part, rho can just be ignored. Nobody cares. General tips: only enter into an option if you are comfortable with the closing transaction. This means if you're required to buy or required to sell 100 shares, make sure that you are comfortable with that. Also, keep in mind if you have to buy or sell 100 shares, if you're going to be losing or gaining compared to the current market price. If you're a call buyer or put seller, you should be comfortable buying 100 shares of the strike. Remember, call buyers and put sellers are the people who are required to buy. So you should be comfortable entering into a call or a put. If you're buying the call or selling the put, you should be comfortable buying 100 shares. If you are a call seller, it is generally recommended that you should already own 100 shares. I'm pretty sure I touched on this, just to touch on it again. This is because if you were to sell this call and you didn't have 100 shares and the price were to go up and become in the money, you would have to buy above market to sell below market. To sell below market. Which is a large loss of money. It's not very fun to experience. I have not experienced it, and I hope you guys never do either. If you are a put buyer, it is generally considered safe to enter into this trade naked. This means not already owning the shares, because either your option will expire worthless or you'll be able to buy 100 shares below the strike anyway. So if you are a put buyer, remember you are selling 100 shares. So when you're buying this put, if you're to buy this 381 SPY put, for $20. If it were to go below 381 and you did not already own 100 shares, you would buy 100 shares at whatever, you would have to buy 100 shares at whatever the market price is, which is below 381, and then you get to sell them for 381. So there's going to be a profit depending on how far below. The way to just avoid all of this is to either only sell if you're very, very confident that the option will expire out of the money and you won't be exercised and you'll be able to keep all the premium. Or if you're a buyer, to just make sure that you have the money to buy the 100 shares, whether if you are required to buy for any reason. And the final way to avoid all this shenanigans is if you are a call buyer or put buyer, to just close your position before expiry. It's generally considered safe to do this a couple days before expiry, because if you get into those last couple hours, sometimes people aren't really going to be wanting to buy your option off of you if it's in the money, because they aren't expecting to actually profit in the next couple hours, if that makes sense. People are only going to buy things from you if they expect to profit from it. At least that is usually the case. Sometimes you might be able to find an idiot, but if you want to trade safe, I recommend closing out all options unless you planned ahead to hold them overnight. Close out all options by market close. And yeah, if you're going to hold overnight, really make sure you understand everything that, all the risks entailed with that, whether it be, the market doing a weird pre-market or after-hour run against you, or, theta decay is something you need to consider as well. If your option has a very high theta decay, maybe you don't want to hold overnight because you don't think that the gains are going to outweigh that theta decay. There's a lot of things you guys need to be thinking about with how you trade options and why you're doing it. My final tip is to check if your broker automatically exercises in the money options at expiry and manage this accordingly. If you're somebody who is buying on margin and you can't afford to cover your option, if it expires, and let's just say that it expires in the money and you never got the opportunity to sell your option, then you can and you don't want to do whatever the option says you have to do, then you can just opt not to automatically exercise. This could be good. It could save you a lot of debt. It could save you a lot of problems if you fucked up somewhere. It's pretty important. And something I skipped, I'll just touch on this really fast, is to check volume for the option chains and stay away from low volume chains. One of the major upsides of options is that you're getting large price movement on a low investment. Now, the problem with this is that it's not traded as liquid as stocks. So when you have an option chain that isn't very active, then you kind of run into problems where you could be up big but you can't find a fill because there's nobody to buy it. So options chains that look something like the SPY chain or something like see, this is an example of a bad option chain. You had a total of 200 options at this strike price today, and this is pretty consistent for the whole chain. So this is not a stock where you would want to be trading options, because it could be very easy to get stuck in this option, or even an option like this, because even the in the money options seem to be very low volume. So you could get stuck in this option, and then you could be in a position where you have to buy 100 shares at $15, but you don't want to. So it's just very important to think about that, guys. Make sure you understand everything that's going on with your options, how they're priced, what the transaction requirements are, how much buying power you should probably have before entering into the position itself. I know with cash accounts, they kind of already hold you to that. That's kind of all I have for you guys. So if you guys have any questions, feel free to hit me up. There's a lot of people in here that know a lot about options. A lot of people a lot more knowledgeable than me. But thanks for watching. Feel free to hit me up, and thanks, guys.